Imagine waking up to a world where oil prices are plummeting and the global economy is on the brink of a significant shift. This is exactly what's happening right now, as oil prices ease due to a surprise build in U.S. crude stockpiles and OPEC Plus considering an output hike. But here's where it gets interesting. The U.S. Energy Information Administration reported that energy firms added 2.4 million barrels of crude into storage during the week ended August 29th, which is a surprise build compared to the expected 2.0 million barrel withdrawal. This unexpected increase in crude stocks has led to a 1% drop in oil prices, with Brent crude futures falling to a two-week low of $66.95 a barrel, and U.S. West Texas Intermediate crude falling to $63.48. And this is the part most people miss. The Organization of the Petroleum Exporting Countries, OPEC+, is set to meet on Sunday to discuss potential further increases to production in October, which could send a strong signal that regaining market share takes priority over price support. But what does this mean for the global economy? And how will it impact the ongoing trade tensions between the U.S. and other countries? Let's dive deeper into the story. The EIA and API reported inventory data a day later than usual due to the U.S. Labor Day holiday on Monday, which might have contributed to the surprise build in crude stocks. John Kilduff, a partner at Again Capital, noted that this is a little bit of a bearish report with that crude build. Meanwhile, OPEC Plus has already agreed to raise output targets by about 2.2 million barrels per day from April to September, in addition to a 300,000 BPD quota increase for the United Arab Emirates. But here's the controversy. Some analysts believe that OPEC Plus is prioritizing market share over price support, which could lead to a further decline in oil prices. Others argue that the output hike is necessary to meet growing global demand. What do you think? Should OPEC Plus prioritize market share or price support? The U.S. economic data suggests that the Federal Reserve might cut interest rates this month, which could boost economic growth and demand for oil. However, the Fed's independence has been called into question, with some lawmakers pressing for a commitment to be politically neutral. In Germany, leading economic institutes have trimmed growth forecasts for 2025 and 2026, citing U.S. tariffs and delays to the boost from higher public spending. And in a surprising move, Russia's largest oil producer, Rosneft, has secured an additional deal to supply 2.5 million metric tons of oil per year to China via Kazakhstan. But what about the impact of U.S. sanctions on Venezuela's oil exports? The country's oil exports rose to a 9-month high of 900,000 BPD last month after U.S. oil major Chevron received a license to allow the country's crude to return to the U.S. market. As the global economy continues to evolve, one thing is certain: the oil market will remain a critical component of international trade and economic growth. But here's the question: what will happen next? Will OPEC Plus increase production? And how will the U.S. respond to the changing global oil landscape? Share your thoughts in the comments below.